So welcome everyone to this amazing revision of Ind AS 115. Okay, this revision is specially for my lovely students from South India. Okay, and this revision is going to be in 100% English. Okay, so before starting the revision of this 115, please remember here in this session we are going to revise two things. One, concepts of 115, of course, yes, and also the important questions of 115. Okay, so these two things we will revise in a very detailed manner, you can say, but it will be from a revision point of view. Okay, second thing, this revision is going to be in 100% English. Okay, so this is specifically for those who don't understand Hindi. Okay, chalo, so without wasting any time, how about starting the revision? Also, if you are watching this on YouTube and if you are watching this revision without subscribing, first subscribe and then watch. Also, if you want the board notes, I prepare some board notes in the class. If you want these, I will upload this on my Telegram channel. You can join the same. The description, in the description box, I will give the Telegram channel link. Okay, chalo. So now let's start the revision of 115 in 3, 2, 1 and go. First of all, number Ind AS 115, name, revenue from contracts with customers. Okay, now in this Ind AS, please remember, no need to ratify each and every word of this, but yes, you should understand the concepts, and I will make you understand the concepts with the help of examples. Okay, and also subsequently, once the revision is done, your focus should be more on questions. Okay, now to start with this Ind AS, remember I had given you a basic example to make you understand why do we do the accounting and how do we do the accounting as per Ind AS 115. Okay, so again, let's go through this example once. So remember, one company was there, Reliance Limited. Okay, and this company was going to provide internet services to me. Okay, so I am the customer, Reliance is the company. Always remember, 115 is applicable to the company who is going to earn revenue, because we are going to study the accounting of revenue. Revenue is earned by this company, so 115 will be applicable to Reliance Limited. Now, for instance, assume that this Reliance Limited is providing 1 year internet service to me, along with, and it says that it will provide the router and installation service for free. Okay, so what did I tell you? Nothing is free in this world. So when Reliance is charging me 10,000 on the first day, it is not charging me only for the internet service, it is indeed charging me for all the three services, and only for the sake of saying, they are saying that it is free for you. No, it is not free. They have recovered the full money in this 10,000. So now what we have to do, we have to allocate this 10,000 into all these three services. So how do we allocate? We allocate in the ratio of SSP. SSP means standalone selling price. Now what is the meaning of standalone selling price? If you provide all the three services individually, how much do you charge? That is a standalone selling price. Okay, so if bifurcate this 10,000 in the ratio of standalone selling prices, we get the allocation. Now what to do with the allocation? See, internet service is a 12-month service, so you need to book the revenue, you need to book this revenue over a period of 12 months. Okay, but these two services are a one-time service, so these two revenue can be booked on day one shot. Okay, so this is the basic fundamental of Ind AS 115. Now to prove this fundamental, Ind AS 115 gives us a 5-step model. Okay, now what is the meaning of 5-step model? So basically it says that whenever you book a revenue, you should follow this 5-step. First of all, step number 1, identify the contract with the customer. Second, identify the performance obligation. Third, determine the transaction price. Fourth, allocate the transaction price to performance obligation. And fifth, recognize revenue. Now what is the meaning of this? In case you remember, identify the contract. In this case, the contract was between Reliance and the customer, where Reliance will provide internet services. Second was identify the performance obligation. Obligation means, from this company's point of view, what is the obligation of this company to provide these three services? These are the obligations for the company. Determine the transaction price. In case the transaction price was 10,000. Fourth point was allocated the transaction price to performance obligation. Now how did we allocate? We allocated in the ratio of SSP. And fifth was recognize revenue as and when entity satisfies the performance obligation. Now how was the obligation getting satisfied? This obligation was getting satisfied over a period of 12 months. So we booked the revenue over a period of 12 months. And these two obligations were getting satisfied in one shot. So we booked the revenue on first day only. So this example teaches you how do we do accounting as per the 5-step. How to remember this CPTAR. Now we will start revising each step one by one. The first step was identifying the contract with the customer. So first of all, in this standard, it says that how do you know when to start accounting for this contract or when to book the revenue under this contract? So it says when it meets all the 5 criteria. See, these 5 criteria are different and the 5 conditions given above are different. So when you meet these 5 criteria, you will start booking the revenue. It will become accounting contract basically. Okay, so what are the 5 conditions? First, parties must have approved the contract. Second, identify each party's rights and obligations. Third, identify the payment terms. Fourth, it must have commercial substance. And fifth, there should be probability that you will be able to collect all of the consideration. If the 5 criteria are met, you can book the revenue under this contract or you can start accounting for the contract. But what if the 5 criteria is not met? If you do not meet the 5 criteria, you should not recognize the revenue. But there was one exception. In case you remember, we discussed one example where even if the 5 criteria are not met, still we will book the revenue. So what was that example? So let's come on towards that example. Here it is. Exception. 5 conditions of step 1 not met, still recognize revenue. Remember, Jay was a customer, I was the company who wants to sell the house. So Jay was interested in buying my house, I was the seller, Jay became the buyer. Okay. So now Jay did not want to immediately buy the house. So what he did, he just booked the house by giving a token money to me. Okay. After 3 days, Jay came towards me and told me that he wants to cancel the deal. So I told him that this token money is a non-refundable amount, so I will not refund it. Okay. So the deal got cancelled and I forfeited his token money. Now tell me, did this token money or did this transaction take place? No. So of course the 5 criteria of step 1 were not met, because it says party must have approved and everything. Here the parties did not enter the contract, it got cancelled. Still this token money, because I forfeited it, it became a revenue for me. So this token money I will book as a revenue even if it did not meet the 5-step criteria. Why? Because I forfeited a non-refundable deposit. This is exactly what it says. You will recognize consideration either if you meet all the criteria of step number 1, all the 5 criteria of step number 1, or the contract has been terminated and consideration received is non-refundable. Okay, so this was one example. I hope you guys are able to recall. Okay, the next point was contract term. What is the meaning of contract term? Contract term means you need to see what is the tenure of this contract. So let's say if I say we entered into a 3 years contract, well, I will give you 3 years teaching services. But we also say that after 1 year, the contract can be terminated without penalty by either of the parties. So here the contract term won't be 3 years, it will be 1 year. Simple. Then combining contract. It says if you enter into multiple contracts with a single party with same or near point of time, then you might treat it as a single contract. When? If it meets any of the 3 conditions. What are the conditions? First, the contracts are negotiated as a single package, or the amount of consideration paid in one contract depends on the price of other, or the goods and services in the contract are a single performance obligation. Sir, give us an example of this. You can see, for instance, you can say that, let's say Rajesh told me that, sir, please teach FR to me. So I told him, okay, I will teach. Rajesh also told me, sir, also take AFM for me. So because he was taking FR from me and now he's opting for AFM also, I am giving him some discount. So even if me and Rajesh enter into multiple contracts, still we can treat this as a single contract. Why? Because the price of AFM is dependent on the price of FR. I gave him discount on AFM because of FR, right? So here the amount of consideration paid in one contract depends on the price of other contract. So here you can treat the 2 contracts as a single contract. Okay. So this was combining contract. The next part, the important part of this step was contract modification. Now what is the meaning of contract modification? Modification means once you enter into a contract, midway you either add some services or you change some conditions in the contract which modifies the contract. So it says contract modification. Now how to account for this contract modification? In case you remember, we have in all 3 possibilities. 3 scenarios are possible. First, modifications that constitute separate contracts. What is the meaning of this? This means even if you modify a contract, you will treat it separately. Sir, when does this happen? Again, let's take some examples. In case you remember, we took the example of painting services. Okay, so let's say AK is the customer, Naga Limited is a service provider who does painting services. Okay, so I told Naga, I want to paint the studio. So he told, okay sir, 25 days, 1000 rupees per day he will charge. Total transaction price becomes 25,000. 115 we are talking about from Naga's point of view. Okay sir, done, no problem. After 15 days, I liked Naga's work, so I offered him that I have one more farmhouse which I would love you to paint as well. Okay, so here, did the old contract expire? No, only 15 days lapsed. Immediately after 15 days, I told him I want to enter into one more contract. So now just see what are the modifications of the new contract. So I am telling him to provide me a new service where I am telling him, now studio you are painting, also paint the farmhouse. Okay, so it is a new service which is being added. Don't say sir, it is painting only now. He was painting studio, now I am asking him to paint farmhouse. New service is added. Plus, I told him how much will he charge for the farmhouse painting. He said still he will charge 1000 per day. No discount he is giving me. That means we are adding a new service, plus the price which is charged for new service is a standalone selling price. That is, no discount is being offered. When these 2 conditions are met, that means when a new service is added and the price is standalone price, this modification is not to be merged with the existing contract. Treat this modification as a separate contract. This is exactly what we say. Modification that constitute separate contracts. Done. Then modification that do not constitute separate contract. That means in these two cases, we will adjust the modification in the existing contract. But here also there are two different accounting treatments. First I'm discussing about this. Come here. Then we will take one more example. Let's say Naga was doing the studio painting, 25 days, 1000 per day, 25,000 total transaction price. After 15 days, revenue booked till date was 15,000. Of course, he was charging 1000 per day. So after 15 days, Naga must have booked 15 days revenue. Over the period revenue he must be booking. Next. Now, what is the modification? I again ask him to paint my farmhouse also. So I am adding a new service. But for this new service, Naga is a nice person. Now he is not charging me 1000 per day. He told that because sir you are availing some old services, I will give you some discount. Okay, so now he's charging only 700 rupees per day. Okay, so that means a new service is being added, but the price he is charging is not standalone. So how to treat this contract? So you will treat this modification in the existing contract only, but how? Whatever is the old contract done, it is done. Don't change it. Just see what is the pending portion of the old contract. So out of 25 days, 15 days are lapsed. So in old contract, 10 days are left. Take that into 1000 rupees per day. Then take the new contract, 12 days into 700 per day. Okay. Computer average rate per day. So it will come to 836.36 per day from 16th day onwards, because 15 days were lapsed now. From 16th day onwards, each day you will book this revenue. This is known as prospective accounting. So here we did not change the revenue already booked. We were like, okay, it is done, once done. Just take the pending part of old contract and take the new contract. Merge them, computer average rate per day or per hour depending on the question. Okay. When do we do this? When we add a new service, but the price is not standalone. Okay. This case. When you add a new distinct goods or service, but the price is not standalone. Okay. Next part. Third case. Original contract was studio painting, 25 days, 1000 rupees per day. After 15 days, revenue booked till date was 15,000 rupees. On 16th day, Naga asked for additional 7 days in the original contract only. So Naga was like, sir, instead of 25 days, I will require more 7 days. So in the original contract only, he is increasing the number of days. So here no new service is being added. No new service. Only we are increasing the days in the existing service. And the price also is not standalone. Okay, when this is done, he will account as per cumulative catch-up basis. Now, what is the meaning of cumulative catch-up basis? Okay, so in cumulative catch-up basis, we do the computation retrospectively. How do we do it? Just try to imagine, what if we had this information from the first day only? What if we had this information from the first day only? Okay, then how would we do the accounting? So it was simple. We will take 25 days into 1000 and 7 days into 800. Basically, computer average rate per day, assuming that we had this information from first day. So what would have been the per day revenue? It would be 956.25. Okay. So now you will see, if I had this information from first day, in the initial 15 days, how much revenue should I have booked? I should have booked this much, 14,343.75. But how much revenue did I actually book? I booked 15,000. So can I say I booked excess revenue? You will have to reverse that excess revenue. And from 16th day onwards, you will book the revenue not as per 1000 rupees, but as per 956.25 rupees only. Of course, do remember I am focusing more on revision here. So if you want to practice these examples, I will upload the board notes on the Telegram. You can join and practice that as well. Okay, so this was the third case. When do we follow the third case? When do we follow the cumulative catch-up basis? When you are not adding any new service. You are changing in the existing service, or you are changing the standalone selling price. Okay. Now to prove this, we also did two illustrations. One was illustration number 9, you can say. Okay, what was happening here? So initially we entered into a contract for 200 hours where he was charging 150 per hour. Now after incurring 100 hours, he said that we have to increase the estimate by 50 hours. We have to increase the estimate by 50 hours. So here we are increasing the number of hours in the original contract only. Okay, at rupees 100 per hour. So here it will fall under the example 3 of our notes, right? So we have to account as per cumulative catch-up basis. How do we do the accounting? First of all, we will check how much revenue you have booked in real. So 100 hours were lapsed. So 100 into 150, you must have booked 15,000. But how much revenue should have been booked? So if we had the increase modification data from the first day only, the rate per hour would have been 140, average rate per hour. So you should have booked 14,000 only. So 1,000 you booked excess, reverse it. Okay, we did one more question here, that was illustration number 8, but I feel there was a small conceptual error in this question. If you read the question, it says it is a machine we enter into a contract to buy a machine, and also 1 year maintenance service. Now this maintenance service, after 6 months, they tend to modify and reduce the consideration of the service. Okay, so when the consideration reduces, it is to be accounted as per cumulative catch-up basis. But they are not accounting as per cumulative catch-up basis. They are accounting it prospectively. That means they are treating it like a example number 2. In my case, if you want to read it, it will be like example number 2. But I feel it should come here, where you should account for cumulative catch-up basis. Anyways, when you read, you will understand. Okay, so this was our step number 1, which we completed. I hope this is very much clear to you. Okay, I have done a very detailed revision of this. Okay, now next point, step number 2, identifying the performance obligation. Now what is the meaning of performance obligation? Performance obligation simply means what is the company promising the goods and services, what services are being promised here. So in case of Reliance Limited, he was offering me internet service, router, modem, etc. That was the performance obligation. So here, what are the obligations being offered? So you need to check on contract to contract basis. And when you are checking the performance obligation, you also need to check whether there is a single performance obligation or multiple performance obligation. Why I need to check that? Because if there are multiple performance obligation, you need to allocate the revenue amount to all the performance obligation. If it is a single performance obligation, that allocation part is not done. Okay, so you need to check whether there is a single PO or multiple PO. But how we will come to know, sir? Okay, so first of all, just get one clarity that it is possible that there are multiple goods and services, still it can be a single PO. What is the meaning of this, sir? For example, when you go to buy a mobile phone, you get mobile phone, earphone, charger, cover, etc. Okay, so here all the goods which you are getting as a package, can I say that they are interdependent, they are interrelated? Okay, and in the context of the contract, they are being given as a one single goods, one single obligation, right? So it will be treated like a single PO, not multiple PO. Okay, so it is possible here we were getting multiple goods, still we treat it like a single PO because they were interdependent on each other. Other example, let's say if you buy the combination of FR lectures, audit lecture and detail lecture from BB virtuals. Okay, here even if you are buying like a combo, can I say you can take the benefit of individual products separately also? So even if you buy as a combo, here it will be treated like a multiple performance obligation because they are not interrelated with each other. Getting my point? So that is what you need to check. So they have given a 2-step model to check whether it is distinct or distinct means whether there are separate obligations or not. Okay, so step number 1 is focus on whether the goods and services are capable of being distinct. That means can you use them separately? And second, focus on whether the goods and service is distinct in the context of the contract. That means they should not be interrelated or interdependent. If they are interrelated, then they are single performance obligation. Okay, so this needs to be evaluated for each and every contract. Do remember that. Next, promise to transfer a series of distinct goods and services that are substantially the same and have the same pattern of transfer. For example, let's say you are buying a subscription of magazines, so you will get 365 different magazines for 365 days. So this will not be treated like a multiple PO, it is like a single PO because it is substantially the same and have the same pattern of transfer each day. Okay, next, long-term contracts. Okay, so if you enter into a 3-year maintenance contract, so what will be the obligation here? So will it be a 3-year single performance obligation or annual 3 performance obligation? So you can say if you enter into a 3-year maintenance contract and it is a non-cancelable contract, it will be treated like a single performance obligation. But if we say that it can be cancelable annually by either of the parties, so it will not be a single PO, it will be 3 POs of annually. Okay, do remember that. This is what we did in step number 2. Step number 2 was done. Step number 1 was identifying the contract. Step number 2 was determining the performance obligation, identifying the performance obligations. Okay, for a moment I got blank only. Chalo. Step number 3, determining the transaction price. Now what is the meaning of transaction price? Transaction price simply means what is the amount of revenue you are charging from the customer. That is transaction price. Okay, so first of all, you will not include the amount of GST. So let's say if I am charging you 10,000 plus 18% GST, the total is 11,800. The revenue amount will only be 10,000 excluding GST. Second, consideration promised may be fixed or variable. Okay, now first of all, what is the meaning of variable consideration? Variable consideration simply means it is like a bonus or something. Bonus, you can take one example. So let's take one example here which I gave in the class. One sec. Here it is. Let's say I told someone to prepare my notes, FR Digest. I call it FR Digest. My concept book is known as FR Digest. So I hired Pawan and I told him, you will work for me for 6 months and he will prepare my digest. So he told me, okay, he will charge 40,000 rupees. Now, I also give him one target that if he achieves the target in 4 months, I will give him a bonus of 6,000. This is variable consideration because whether he will receive this money or not, it is dependent on a future outcome. It is variable. Okay. So Variable consideration can be positive also. Acha, it can be negative also. Let's say I tell him that if you take more than 6 months, I will charge you a penalty also. Then here it is a negative variable consideration. It can be either of it. So first of all, whether variable consideration should form part of transaction price, the answer is yes. But how will you estimate the amount of variable consideration? We have two methods. One is expected value method. When to use this? When there are multiple outcomes possible. So just take the probability of each outcome. Simple. Second is the most likely outcome. It is more likely to be used when only there are two outcomes possible. Okay, either you will get the bonus or not get the bonus. So here you will consider the most likely outcome. That means, let's say for example, I will get the bonus, probability is 80%. So this is my most likely outcome. One important thing in second method, don't multiply by probability. Once you get to know this is the most likely outcome, take the full gross amount. Okay, so this is how you estimate the variable consideration. So variable consideration will form part of your transaction price, and the estimated amount, we have two methods for it. Okay, next, constraining estimates of variable consideration. This simply means if you are unable to estimate the amount of variable consideration, or there are some constraints in estimating the variable consideration, then it will not form part of your transaction price. So there are few indicators which are given, which will help you know that here it is not possible for you to identify the variable consideration. So in this case, you will not include in the transaction price. Is this clear till here? So this was the second point of transaction price till here. Okay, chalo. So I guess we had studied till here. Then now we will continue with our remaining portion. Then we will revise the remaining portion as. Okay, chalo. So guys, let's continue. We had revised till this point. Okay, the variable consideration and constraining estimates of variable consideration. We did till here. Chalo. Now the next revision point is significant financing component. Now what is the meaning of significant financing component? Please have a look here. So basically, if you remember, I give two examples to you. Okay. In first example, Chroma was a seller who was making the sale on day one, but this company will receive the payment after 1 year. So of course, when it made the sale, the price was 1.5 lakhs, but because it is going to receive the payment after 1 year, it will charge 20% interest. So it is charging 1.8 lakhs. So the question is, when will Chroma book revenue and how much revenue should Chroma book? So always remember this basic rule. Revenue booking should be done on delivery date. At delivery days, transaction price. So basically, when is the delivery happening? First day. So book the revenue on first day. At what value? If the customer made the payment on this date only, how much it would have paid? 1.5. So book the revenue at 1.5. So what about the excess that the company is charging? That is interest. So this is how the accounting will look like. Okay, it will book a receivable to revenue. 1.5. Revenue is book 1.5. Then receivable being a financial asset, accrue the interest and then receive the money. Okay. There can be an example number 2 also. In this case, Chroma is selling the laptop, but the delivery is happening after 1 year. Okay. So basically, when we sell and the delivery is happening after 1 year, but here, if you make the payment on delivery date, you are going to pay 11 lakhs. But Chroma also gives an option to the customer where if it makes the payment early, it has to pay only 10 lakhs. Okay. So the seller opted for this option where it is making the payment early, paying 10 lakhs. So basically the purchaser is paying 10 lakhs. So basically purchaser is paying less. Okay. Now how to treat this? First of all, again, same question. When should we book the revenue? Revenue should be booked on the date of delivery, that is after 1 year. At what amount? If we made the payment after 1 year only, then what would have been the amount? 11 lakhs. So book the revenue at 11 lakhs. But sir, the company will never receive 11 lakhs now. So here basically it is like a cash discount. In Ind AS terms, we call it notional interest. Okay. So what the interest does is, we record the money received like advance. Okay, we accrue the interest expense or we debit the cash discount, whatever you may call it, and then we receive the then we transfer the advance to revenue. So basically in P&L we show revenue 11 lakhs and this interest as 1 lakhs. Basically we are not showing the revenue net basis, we are showing the revenue as a gross amount, and whatever discount or interest you are showing, it will be shown separately in the expense side. Okay, so the second example is more important because the first is very easy to understand, second is little tricky, so always remember that part. Okay, so this was significant financing component. We have few questions also in this that I will revise later on. Then we have this point of non-cash consideration. Now what is the meaning of non-cash consideration? In simple terms, I will call it barter transaction. For example, I give teaching service to Jay and Jay in return files my ITR instead of giving me money. So talking from my point of view, AK's point of view, at what value should I record the revenue? So 115 gives us two preferences. 115 says first preference should be given to fair value of service received. Okay, fair value of service received. So you received which service? You received ITR service. So what is the fair value of ITR? 9,000. Record the revenue of teaching at 9,000. Simple. If this was not available, then you will record at fair value of services given up. Simple. Acha. Also, I have given a summary of barter transaction in various Ind AS because this is a little contrary to what we studied in 1638-40. In 1638-40, we give 16 means PP, intangible investment property. So here we give first preference to fair value of asset given up plus cash paid. If that is not available, then fair value of asset acquired. But in case of 115 and 102, 102 means share based payment, we give first preference to fair value of goods service received. Okay, chalo. So do remember this part. Done. Then the next point is customer provided goods or services. What is the meaning of this? Sometimes what happens is customer itself provides the raw material so that the company can give the services. For example, see, I have some gold. I deliver my gold to the company and ask the company to make a gold chain out of it. So I am providing the raw material. Okay, and company is delivering the gold chain out of it. So here, how should this company book the revenue? Should the company book the revenue only for the making charges, or it should book the revenue on gross basis? So standard says you need to identify when customer transfers the gold to that company, is the control of gold getting transferred? If you say that the customer is transferring gold and the control is also getting transferred, so this company will book the purchase of gold first, and then whatever it delivers to the customer by converting that gold into gold chain, it will book the sales separately. So book the purchase separately, book the sales separately. But if you conclude that the gold control was not getting transferred, so in that case, this company will book the revenue only for the making charges. It will differ from case to case basis. It is just like I also took one more example. Let's say, for example, I have a car. Okay, I have a car which is Thar. Okay, so I give my car to a company to modify that car. Okay, so now here I'm not transferring the control of my Thar. Okay, because the Thar before also belonged to me, afterwards also it will belong to me. I have transferred to the company only to make some modifications. I will receive it back again. Okay, so here when you conclude that I'm not transferring the control, that means this car modification company should book the revenue only on net basis, whatever it has charged for the modifying the Thar. Okay, simple. So this was customer provided goods or services. Next point, consideration payable to a customer. See, ideally when the company sells anything, it receives consideration for the customer from the customer. Here the point is consideration payable to a customer. Sir, when will you pay the consideration to a customer? So here there are three cases which I discussed. Case 1, you might pay the consideration to the customer in the form of a cashback. Okay, for example, you are Paytm company, so Paytm receives 100 rupees and gives a cashback of rupees to the customer. So here Paytm should record the revenue on net basis. First case. Second case might be, let's take for instance, AK sells AFR lectures to Ajit. So for AK, it will receive 10,000 rupees. But AK also buys a camera from Ajit. That is, I am buying some goods from the customer for which I am going to make a payment of 7,000. So here a consideration is payable to the customer, not in the form of cashback. It is payable because I am buying something from my own customer. On one hand, I am selling something. On one hand, I am buying something from him. So here, from AK's point of view, it will record the revenue separately and the purchase separately. He will not net this off because I am making the payment for a distinct goods and services. In cashback, that was not happening. Okay? Acha. There is one more case 3 also. The only difference in case 3 is it is same as case 2. But sometimes what happens is we tend to inflate the purchase and sales value just to increase our turnover. Okay, so if in question it is said that the sales and purchase are inflated by 2,000 rupees. So in that case, if you can clearly see that, you need to record the purchase and sale at before inflated value. You cannot inflate the value and record it basically. Okay. Of course, it is very difficult to find this out in real life, but it is there. So just remember that part. So these are the points. So as I mentioned, for this, you should refer case 1. For this, you should refer case 2. And for this, you should, for this, you should refer case 2. And for this, you should refer case 3. Once you read, you will understand everything. I hope this is clear to everyone, guys. Yes, perfect. See, so here it is. Case 1 relates to this. For this case 2 and for this case 3. Simple. Okay, chalo. Don't worry, I am uploading this board notes on my Telegram channel. You can download and you can just refer and enjoy. Okay, chalo. The next part is, in this only we have some few parts. In consideration payable to a customer, we have few other cases also. One is slotting fees. What is the meaning of slotting fees? Please have a look at my example. Suppose you are Puma company. You make some sale to Lifestyle. Lifestyle is a brand. Okay, Lifestyle is a brand where all the multiple brands stock is available. Okay, so I make a sale to Lifestyle. Now, in Lifestyle store, it also offers that we can choose shelves in their store. Okay, so basically Puma can choose where its products will be shown under the lifestyle store initially or at a later stage. So basically lifestyle will charge Puma for choosing the shelf. Okay, so it is known as slotting fee, slots. So here Puma is receiving 10 lakhs, but on the other hand it is also paying 50,000. So here Puma should record the revenue on net basis 9.5 lakhs. Simple. Next point, cooperative advertising arrangements. What is the meaning of this? Same example. Puma is making a sale of 10 lakhs. Lifestyle offers to make some advertisements for Puma. Okay, that is Lifestyle is providing advertisement services to Puma and it is charging 1 lakhs. So basically Puma is receiving 10 lakhs and paying for advertisement as 1 lakh. How should Puma record the revenue? So here it is ambiguous. It says it will differ from case to case basis. You need to check. So it can be either be net or either be gross. It depends. Okay, do remember that. Chalo. Third is price protection. Let's say if I make a sale to any of my student, okay, and I promise that if, let's say I'm selling my FR lectures to a student for 10,000 rupees, I promise that if the price of this lecture falls in future, I will refund the money to the student. Okay, I will refund the excess money to the student. So I promise this, and after, let's say, a couple of days, I started selling my lectures for 8,500. Okay, so because of which I have to refund 1,500 to my student now. This is known as price protection, where you offer a protection in case of decrease in the price. So now in AKS P&L, how should the revenue be recorded? So it says on net basis. Simple. I hope this is clear to everyone. Okay, done and dusted. So this was your step number 3, which we completely revised. Clear with this, guys? Okay. Now we move on towards step number 4, and that is allocating the transaction price to performance obligations. Okay, allocating the transaction price to performance obligation. What is the meaning of this? Remember my Reliance example, where Reliance was providing me 3 services and charging 10,000. So I allocated that 10,000 between all the 3 services in the ratio of standalone selling price. That is exactly what we will do in step number 4. Allocate the transaction price to each performance obligation on a relative standalone selling price basis. Okay, so here there are 4 examples which you need to understand. Please have a look at my examples. You will understand all the concepts through this only. First, let's say I'm selling a combo of group 1, FR, AFM, audit and law. Assume that law is also there. So I'm charging 20,000 as a combo price. Okay. Now, but the SSP is individually little higher, of course. SSP means if I sold them individually, how much will I charge? So total comes to 28,000. So now I want to bifurcate this 20,000 between all the 4 subjects. How will I bifurcate? Simple. You will bifurcate in the ratio of SSP. Okay. So allocation is done in the ratio of SSP. So that means you are given discount on all the products. So when you bifurcate the transaction price in the ratio of SSP, do remember one thing, even the discount is getting allocated in the ratio of SSP. Okay, this is one example. First, done. Second example, let's say you are selling a combo of only FR and AFM for rupees 8,000. Okay, if you see individually, they are worth 16,000, but you are selling only for 8,000. That means you are giving a discount of 8,000 rupees. Okay, you allocate between the 2 products. Continuing with the same example, assume that you also sell one more combo, that is a combo of 4 subjects, FR, AFM, audit, law. You sell for 20,000. If you see the SSP, it is coming to 28,000. How much discount did you give? You are giving a discount of 8,000 only. If you see closely, when you were selling only 2 products, you gave a discount of 8,000. When you are selling 4 products, you still gave a discount of 8,000. That means here the discount is being given only on the first 2 products. Why? Even if you are adding 2 more products in the combo, you are not giving any additional discount. So in this case, even if I'm adding audit and law in the combo, I'm not giving any additional discount. So in this case, don't allocate the discount in the ratio of SSP. Standard says in this case, the discount will be allocated only between FR and AFM. Okay, this is exactly what I've made you right here. When discount on small bundle of goods is same as discount on larger bundle, then whole discount will only be allocated to smaller bundle of goods. Simple. Okay, chalo. Example number 3, residual approach. Now, what is the meaning of residual approach? I'll try to explain you. Please have a look here. First of all, we know that we have to allocate on SSP basis. Okay. Sometimes SSP is not available. Sometimes SSP is not available. So we will estimate the SSP. If SSP is not available, estimate it. We have 3 methods for estimating. First, if your own SSP is not available, check the price of competitors. Okay. If even that is not available, you will try to estimate the SSP through this method by calculating the expected cost plus a reasonable margin in your business. You can find the selling price. If you can't use this method also, then you will use residual approach. Now, what is the meaning of residual approach? So basically here, let's say for example, you are selling a combo of 24,000. You are selling FR, AFM, audit and law. You don't have the SSP of law. Okay. Second thing, how much discount did you give on the first 3 products? You already have this. This is given in the question. Okay, assume this. That is given in the question. So out of 24,000, 7,000 you are charging for FR, 7 you are charging for AFM, and 500 are charging for audit. How much will you charge for law? You can't allocate because SSP is not available. So in this residual approach, you will take the balance of law as a balancing figure. How did you calculate the balancing figure? Take the total transaction price, deduct the after discount price of the remaining products. So as a balancing figure, you will get the price of law. Simple. Okay, chalo. So this is how we compute the price of law. Always remember, residual approach can be used only if the price of one PO is not available. See, only if one price is missing, you can use this method. Second, if the value after residual approach comes to 0, this method cannot be used. It is obvious. If it is coming to 0, then something is wrong here, of course. Okay, we took one more example. Example number 4. This example is also based on residual approach, but the only difference here is we have the SSPs of 3 products. For law, we can't say we don't have the SSP. We have a range of SSP. Basically, law, I don't sell for a single price. I sell for variable prices. I sell for 4,000 also, 5,000 also, 6,000 also, 8,000 also, 10,000 also. Okay. So law, I have a range of SSPs. So in this case, when you use residual approach and you get the allocated amount of law, if you get this amount within the range, then you can use this method. But sometimes when you calculate the balancing figure, this amount is not coming within the range. In that case, you will say residual approach cannot be used as allocation. Is not within the range. Okay. So then which method to use, sir? Then you will have to by default use the remaining 2 methods to calculate SSP. You can't use residual approach. Okay. So these are the 4 cases in case of you can say step number 4. So if I just want to quickly overview the step number 4 again, you will say first allocate the TP in SSP if nothing is mentioned. Achha. If you don't have the SSP, try to estimate it. Okay. Then how will I allocate discount? Normally we allocate discount in the ratio of SSP only, but can I say in few cases discount was not getting allocated in the ratio of SSP, like we saw in example number 2, where I was selling the combo of small products and the combo of more products. So here I was allocating discount only on FR AFM because discount was same in both the combos. So this can be an exception to allocating the discount in SSP ratio. Acha, one more point is there. What if there is any variable consideration? Just check variable consideration is promised on which product. If it is promised on entire contract, allocate in the ratio of SSP in entire contract. If it is promised only on a specific part of the contract, on a specific performance obligation, allocate only in that performance obligation. Simple. Okay. Last point in step number 4 is changes in transaction price. What if there are any estimate changes in transaction price? For this we have 32, which I will revise. Don't worry about it. Acha. Now to understand step number 4 better, we always have one question, that is illustration number 55. I will revise that question also. Please have a look here. Illustration number 55. Here it is. Please have a look here. What does it say? An entity regularly sells products X, Y, Z individually. Okay. So it sells X, Y, Z individually. SSP is given. It also says we sell Y and Z together. If you only have a look at Y and Z, the SSP is 25 and 45. So it comes to 70,000. You sell it for 50. That means on Y and Z, you will give a discount of 20,000 rupees. So I allocated first Y and Z, the discount of 20,000 in the ratio of SSP I allocated. Now case 1. It says we sell XYZ for 1 lakh. Okay, we sell XYZ for 1 lakh. If you see the SSP of XYZ, all 3, it is 120. You sell it for 1 lakh. That means on all 3 products, how much discount are you giving? You are giving a discount of 20,000. And if you see closely, on the 2 products also, you give a discount of 20,000. That means on this extra product X, you are not giving any extra discount. That means in case A, the discount will not get allocated to X. It will only get allocated to Y and Z. Simple. Case B. It says along with XYZ, we also sell alpha, but we sell for 1,30,000. Okay. And range of alpha is given. How to calculate the value of alpha? It is simple. See, you have the data of first 3 products. Okay. Discount is available. You can use from case number A. On X, you are not giving discount. On Y and Z, you give discount. After discount value, you have of first 3 products. So you are charging 1,30,000. Deduct the after discount value of all 3 products. You get the price of alpha. For alpha, you are charging 30,000 rupees. Is it within the range? The answer is yes. you can use residual approach. It is appropriate. If you see the last case, it says everything is same, but instead of 130, we are charging 1,05,000. Okay. So here in this case, if instead of 130 you are charging 1,05,000, the allocated amount for alpha will come to 5,000. It will not fall within the range. So can you use the residual approach? The answer is no. You will say residual approach is not appropriate. Simple. I hope this is clear to everyone. Perfect. Chalo. So this was your which step? Step number 4. Now we move on towards step number 5. That is, recognize revenue as and when entity satisfies its performance obligations. Okay. So when should the company book the revenue? See, you can book revenue in two ways. Either you can book the revenue over the period, or either you can book the revenue one shot. That is on one single day. Either it can be first day, it can be last day. Okay. So how to book the revenue? You should book the revenue in the same way in which your goods and service are getting transferred. If the goods and service are getting transferred over the period, book the revenue over the period. If the goods and service are getting transferred one shot, book the revenue one shot. Simple. Okay. So basically, when will the goods and service, or when will the asset be considered to be transferred? When the control is transferred. Some indicators of control are given. Just give a read. Now the main point comes here. How will I identify whether any goods or service is getting transferred over the period or it is getting transferred at a point in time? So there are 3 cases given. Okay. Standard says if any one is met out of all these 3, then transfer of control is happening over the period of time. Book the revenue also over the period of time. But if neither of it is met, then you will say control is getting transferred at a point in time. In this case, book the revenue also at a point in time. Okay, chalo. So now we will try to understand all the 3 cases. First, customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. What is the meaning of this? Just assume my live teaching service. Let's say, for example, you enroll for my live lectures. So as and when the entity performs the service, customer gets the benefit. Okay. So in this case, as soon as I'm teaching, you get the benefit instantly. I teach, you get the benefit instantly. Okay. So my service is a service which is happening over the period of time. Second, entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. For example, whenever you perform any service on customer's asset, for example, customer has a studio, you are providing painting services on the customer asset. So this painting service will be considered to be transferred over the period of time. That is exactly what it says. When you perform any service on the customer's asset, it is a service of over the period. Second case. Third case. Just remember in third case, if you are making any customized asset for the customer, and if on cancellation, you can recover cost incurred till date plus a reasonable profit margin. Again, I'll repeat. If you are making any customized asset for the customer, and if the customer cancels, you can recover cost incurred plus a reasonable profit margin. If both these conditions are met, then you will say control is getting transferred over the period. But if you are making a customized asset and cancellation can be done free of cost, then the control will not be considered to be transferred over the period. Second thing, if you are making a customized asset and on cancellation, you are charging a flat penalty, still you will say control is not getting transferred over the period. Okay, so do remember, it should be a customized asset. Second, on cancellation, you should have a right to recover the cost plus margin. That is the case, you will say control is getting transferred over the period. Okay, this was your transfer of control point. If none of these 3 cases are met, you will say revenue is control is getting transferred at one point, book the revenue at a single point in time. Okay, now one more thing. When I say that we should book the revenue over the period does not mean equally. For example, I'm going to teach FR for 3 years. I charge 9,000 rupees. So if I ask how should I book the revenue, don't say equally over 3 years. It will not always be equally. It can be equally but not always. If I tell you that in year 1 I thought to 50% of the portion, okay, that means in year 1 50% revenue accrued, so book the revenue 50%. In year 2 if I thought to 30% portion, book 30% revenue in year 2. In year 3 if I thought to 20% portion, book 20% revenue in year 3. That means how much revenue you will book each year. How much revenue you will book each year will not be same. You should match you should see how much service has been fulfilled. So there are 2 ways of measuring progress. Why do we need to measure progress? Because how much ever progress has happened, that much revenue we will book each year. So this measuring progress is only relevant when the control is getting transferred over the period of time. So we have two methods. One is output based method, one is input based method. In output based method, we use survey of performance completed to date. Basically, in AS7 we used to take percentage of completion method or stage of completion we used to check. That is what you can see to check how much work was completed. Output based method. Second can be input based method. Here the most common method is checking how much cost has been incurred compared to total cost, or how much labor hours has been incurred compared to total labor hours. So input based method. Okay, do remember that part. So this is how you can measure the progress to book the revenue. How much revenue to book each year, you will come to know. Acha, we have a note. For note, I will teach you a direct illustration. Don't worry about it. Then, if none of the criteria of above are met, we will assume that control is getting transferred at a point in time. Okay, this is what we have done. Okay, now we move on towards the special cases. Now, what all special cases? Acha, before special cases, I also did one illustration number 32 with you. Chalo, I will revise that illustration also. Okay, come. We will revise this illustration number 32. Please have a look here. See, this revision is very important for you guys. Ultimately, in the first go, everyone will understand, but how to concise this revision will be super helpful for you. Okay, do let me know if it was helpful. Anyway, chalo. So illustration number 32. Let's say in this we have a fixed fee contract of 1 million. 1 million means 10 lakhs. And here the cost is going to be 9 lakh 50. It also says control is getting transferred over the 5 years, and cost to cost input method is used to measure progress. That means your total cost was 9 lakh 50. Let's say you incurred 50,000 in first year. So this is how you will determine the percentage completion. So 50,000 divided by 9 lakh 50. This much work was completed. Book this much proportionate revenue. Okay. So this is for fixed fee. Apart from that, we also had a variable fee. Okay. It was variable. If you achieve this much, then no incentive. If you achieve this much, 1 lakh incentive. If you achieve this much, 2.5 lakh incentive. Okay. Now the standard says that we are going to use most likely amount method. And initially the most likely amount is 10%. So variable consideration as of now is going to be 1 lakh. So how will you account for this? Please have a look here. So first in year 1, 2, 3, 4, 5. Okay. Fixed revenue is going to be same. So book the revenue each year based on the ratio of cost incurred. Okay. The ratio of cost incurred is given in the question. Book that much revenue each year. Okay. For variable consideration, our estimate is 1 lakh. So we book the variable consideration also as per 1 lakh only. But for 3 years, it was 1 lakh only. But when you read the question further, it says, at the end of 4th year, our estimate changed. Our estimate of variable consideration changed. Now we feel that we will be able to recover 25% incentive. Okay. 25% incentive is more probable now. In this case, what to do? So standard says, if now your estimate changes, so in the 4th year, you will book the revenue on variable consideration as per 2.5 lakhs. That is fine. But can I say on the first 3 years also, you should have booked as per 2.5 lakhs. So you have to do a cumulative catch-up adjustment in year number 4. How will you do it? A simple working note. If you are able to prepare this working note, your solution is done. What is the working note? First of all, you will check variable consideration to be booked till year 4. How will you find this? Take 2.5 lakhs, multiply by the cumulative cost incurred till 4th year, divide by total cost. So you will get this much revenue should have been booked for 4 years on variable consideration. Now compare this with how much you have actually booked. Less variable consideration actually booked in 4 years. Okay. So this much should have been booked, but you only booked 138. How will you get this? Just see na variable consideration. How much did you book in first 4 years? Okay. So this is additional to be booked. So record this in cumulative catch-up adjustment. Simple. Add ABC. You will get total revenue. In this question, what was asked? They had asked us the revenue amount. They had also asked us the margin amount and the margin percentage. So revenue you get. Cost was already given. So deduct cost from the revenue, you will get margin. Okay. Then profit, that is margin upon revenue, will give you margin percentage. I did for 1 year. You can do for the remaining years. It is simple. Clear with this? Okay. So in this question, only the 4th year adjustment is important. Rest everything is simple. Chalo. Let's proceed further. Now we have illustration number 31, I guess. Let me see. 31 was also a very good question. What does it say? HT enters into a contract with a customer on 1st April 11. Okay. For selling at rupees 1000. It also says that if we produce more than 100 units, the price will retrospectively be reduced to 900 rupees per unit. Very good. Now, for the first quarter, estimate is that a customer purchased 10 units and the purchase will not exceed 100 units. So in that case, book the revenue as per 1000 rupees. So in the first quarter, we sold 10 units. We book the revenue as per 1000 rupees. Very good. Okay, no problems here. Now in the second quarter, what happened is the customer purchased additional 50 units. Okay, and our estimate revised. Now we feel that we will be able to sell more than 100 units in the full year. So price has to be reduced by 900 now. Sorry, price has to be reduced to 900 now. How should the revenue booked in second quarter? So in second quarter on the 50 sale, you will book as per 900. But can I say the 10 units which you sold previously, you have booked 100 rupees extra. So you will reverse that also. So ideally in second quarter, you will book the revenue on 50 units and you will reverse the excess revenue on 10 units. So net revenue will book this much. There is also an alternative way of doing it, not discussing it now, but you can also check it out if you have a second method as well. Okay, done with that. So this was illustration number 31 and 32. Is this clear to everyone, guys? Yes? Chalo, perfect. Now let's proceed further. We have some special cases also with us. Please have a look at the special cases. First special case is principal versus agent. So standard says whenever there is a principal agent relationship, try to identify, okay, who is the principal, who is the agent, because the principal will book the revenue on gross basis, agent will book the revenue on net basis. Okay, so always check for the indicators, who is the principal, who is the agent. For example, our lectures are being sold from BB virtuals also, but our lectures are sold at zero in fees. Zero in fees is a franchise which sells our lectures also. Okay, so let's assume they charge 10% commission. Now, how to identify who is the principal, who is the agent? See, there can be a principal relationship also. Then can be a principal agent relationship also. I will teach you, don't worry. So let's say, for example, there are some indicators given. First indicator is which entity is responsible for fulfilling the contract. Can I say even if zero in fee makes the sale of our lectures, BB virtual has to fulfill the contract of teaching. So BB virtual is the principal here. Second, who has the inventory risk? If zero in fee is not able to sell, who will bear the risk? Of course, we will have to bear the loss now of books and everything which is printed. Third, who has discretion in establishing prices? Who will decide at what price to sell? Of course, I will decide. He is the agent only na yaar. So this means BB virtual is the principal, zero in fee is the agent. Now what is the difference? When BB virtual records the revenue, it will record the revenue on gross, and whatever commission it gave to agent, it will record as commission expense. What about zero in fee? Zero in fee will record the revenue only of their commission amount, that is 10% of 10,000. Just an example. Okay, so to understand the principal agent relationship, we also have two questions. You can always refer those questions. I will just go through this once very quickly. In illustration number 27, always see I discussed only 3 indicators. There can be more than 3 indicators also. Okay, so whenever question is given, whenever you are reading a question, just see maximum condition should be in your favor. Not all, but majority should be in your favor. So here there are 2 companies, D and F. So if you see closely, in D's favor there are maximum conditions. So D is the principal. Okay, if you read, you will understand. Similarly, you have this case also. Okay, here the relationship is of principal, not principal agent. Why? You will, once you read, you will understand. So just read this question once. Okay, chalo. So this was first special case. Second special case, non-refundable upfront fees. Now what is the meaning of non-refundable upfront fees? Simple. Let's say for example you go to gym. Okay, they tell that you have to pay membership fees of 1 year of rupees 12,000. But they're also charging you some registration fees, which is a one-time fee. Now, how should the company book this revenue? So ask the company whether you gave any distinct goods for this registration fees. Let's say, for example, the company says we gave a gym bag, we gave a gym kit for this registration fees. So this registration fees is a separate PO and this membership fees is a separate PO. Book the membership fees over the period, book this registration fees at one shot. But if for registration fees, company is not giving any distinct goods or service, in that case, he will merge this 2 amount and you will call this full amount and book this full revenue over the period. Book this full amount over the period. Non-refundable upfront fees. Simple. Then, third case was customer options for additional goods and services. What is the meaning of this? A simple point here can be, let's assume you gave a customer an option to buy additional goods and services. That means you, for example, you sold a ticket to customer and you gave some free vouchers. Okay, you gave some free vouchers. So let's say you sold 10 tickets to customer worth rupees 250 and you gave 2 tickets for free, which the customer can redeem after a few days. Okay, these tickets are worth little less because they are weekday tickets. Okay, so in this case, whenever you receive any consideration, you will say there are two performance obligations here. One is the tickets of Sunday and one is the tickets of Wednesday, which you gave for free. Even if you gave for free, it is a performance obligation. Whatever money you received on day 1, you have to allocate between both the POs. Okay, in the ratio of SSP. So don't bifurcate in the ratio of number of tickets. Bifurcate in the ratio of their SSP. So 10 tickets were worth 250 each and 2 tickets free were worth rupees 100 each. So bifurcate in the ratio of SSP. Why to bifurcate? Whatever allocation comes to this 10 tickets, you can book the revenue on day 1. But whatever allocation comes to is 2 tickets, you cannot book the revenue today. You will book the revenue in future when either the customer uses the voucher or the voucher lapses. Okay, so as on today, you will book like a contract liability for that 2 tickets, and then in future when the customer ideally avails it or it lapses, you can book the revenue. Okay. Also, one more thing, whenever in question there is probability given, take that also into consideration. To understand this better, we had one example. Illustration number 23 we had. Please have a look at the illustration number 23 here. Wait, I will teach you. Illustration number 23. What does it say? An entity enters into a contract for a sale of product A for ₹1,000. It gave a discount voucher of 40%. Okay. So it is not giving a free voucher. It is not like you can come and purchase anything for free. You will get a discount in future. Discount voucher is given. Okay. 40% discount voucher is given. In the next line, they say 10% discount we give to everyone only. 40% voucher we have exclusively. 10% it gives to all the customers, and this 40% cannot be availed in addition to 10%. That means effectively how much discount voucher did you get? 30% only. How come 30%? See, 40% voucher you have, 10% voucher to everyone in this world has. So effectively you are getting extra voucher 30% only. Okay. Probability of availing is 80%, and on an average customer purchase in future only ₹500 products. How many POs are there? So how to solve this? Please have a look here. On day 1, customer is receiving ₹1,000. There are 2 POs. One is a sale of product, one is a discount voucher given. What is the SSP? SSP product A is 1,000 only. The important part here is finding the SSP of discount voucher. How will you find this? Just take how much purchase will the customer make in future into the discount percentage, effective discount. Don't take 40, take 30 only, because the effective discount 30% only, into the probability. Okay, this is the effective discount which you will give in future. Okay, so this is the SSP of product A. This is the SSP of discount voucher. Just bifurcate this ₹1,000 in this ratio. Whatever gets allocated to product A, you can book on day 1. Whatever gets allocated to discount voucher, you should not book on day 1. You should ideally book it when the customer redeems the voucher or when the voucher expires. Simple. I hope this is clear to everyone. Yes? Chalo. Next point is sale with a right to return. What is the meaning of this? Sometimes what happens is company makes a sale to the customer with an option that customer can return the goods in future. Okay. So how to book the revenue? Please have a look here. That is sale with a right to return. So I took one example here. I will try to explain everything with the help of example. Let's say Amazon sold 10 laptops to Ajita for 1 lakh each. Cost of laptop was 75,000. There is a 30-day return policy. Amazon expects 3 laptops to be returned. Okay. Now how to account for this? How to account for this? So whatever laptops you expect to be returned, you cannot book the revenue on those laptops. So even if you receive the money of 10 laptops, book the revenue only of 7 laptops which you don't expect to be returned. Okay. Balance amount of 3 laptops will be shown like a refund liability. First thing. This entry is very simple to understand. Second thing, on one day one more entry will come where Amazon has a obligation to give the money back on return. It also has a right to recover the laptops from the customer. Okay. So it will record the right to receive asset and credit to COGS. Okay. At cost of the asset. So 3 laptops, whatever is the cost, you will record this. Okay. So the second entry on day 1 is important. Now, what will happen after 30 days? This I have discussed extra. In module it is not discussed. Okay. After 30 days, there can be 2 scenarios. Customer return the laptops. So whatever refund liability was there, refund the money to customer. So refund liability to cash bank. What about this right to receive asset? You must have received the asset also. So reverse this entry. COGS to right to receive. If there are no returns, then transfer the refund liability to revenue. What about this right to receive? This will lapse now. So just reverse it. So under both the cases, this entry will ultimately reverse only. Okay. Acha, what if customer returned only 2 laptops? What will happen in that case? In that case, reverse the refund liability completely. Give money back on 2 laptops. Book the revenue on 1 laptop. This entry any which ways will get reversed only. Okay. Chalo. Now to understand this better, we had a very simple question, that is illustration number 34. Okay. It says that we are going to sell 1000 contracts for ₹50. So this is how much we are going to receive, 50,000. Now it estimates that cost is 30 rupees. Very good. We estimate that 970 will not be returned. Out of 1000, 970 will not be returned. So please have a look here. We received this much money. We can book the revenue 970. Remaining you will book a refund liability. Okay. Also, the 30 items which you expect to be returned, record a right to receive also at the cost of asset. So 30 products into 30 rupees. Right to receive to COGS. That's it. They have not talked about what will happen after 30 days. Okay, do remember that part. So this was sale with right to return. A interlink point with this is restocking fees. Restocking fees. What is the meaning of restocking fees? It means whenever you make a sale, you say that, for example, Amazon makes a sale with a right to return. Amazon tells one thing, that on return, Amazon will not return the full money. It will deduct 1000 for packaging and delivery fees. Okay, that means if the customer returns the laptop, ideally customer should get full 1 lakh. Amazon says we will deduct 1000 for each laptop, because ideally we will incur some charges again, packaging charges, delivery charges. So Amazon will return only 99,000 rupees. That means Amazon is charging 1000 as restocking fees. So you can see here, continue with previous example, that on return, Amazon will charge 1000 as restocking fees on each laptop, and net refund on each laptop will be 99,000 only. So in this case, the day one's entry will be modified. You will receive the money 10 lakhs. When you say refund liability, normally a refund liability was 3 lakhs. Here it won't be 3 lakhs. It will be 3 laptops into, not 1 lakhs, into 99,000. Why? Because ideally maximum refund which will happen is 99,000 per laptop, not 1 lakh. Okay, so this will be refund liability, and revenue here will not be 7 lakhs, it will be 7 lakh 3,000. How come 7 lakh 3,000? For 7 laptops, 1 lakh is accrued. For the 3 laptops which you expect to be returned, can I say 1000 rupees ultimately we will not return only? So this much revenue you can book, 7 lakh 3,000. Second entry remains the same, restocking fees. So if you see closely, what all things we have revised? Step 1 completely revised. Step 2 completely revised. Step 3 completely revised. Step 4 completely done. Step 5 completely done. Okay. In special cases, we have done principal versus agent, non-refundable upfront fees, customer options for additional goods and services, that is discount voucher question, sale with right to return, and accounting for restocking fees. We have done till here. Right? Chalo. So remaining revision, of course, I will do post this now. Clear with this? Perfect. So guys, let's continue with the revision. I guess we had completed the revisions till restocking fees. Okay, we did till here. Okay, now if I want to show you the chart, it is something like this. So we were under special cases and we completed till here. Okay, warranties. Sorry, not here, till point number 5. Now we will continue with this point, warranties. Okay, chalo, have a look here. So what does it say? See, under warranty, when do we receive any warranty? So basically whenever you buy any product, so the company gives you any warranty. So for the company, it is giving a product also and giving a warranty also. So normally it is a 2 performance obligation, product and warranty both. But standard says whether to treat the warranty as a separate PO or not. So if the warranty is a compulsory type of a warranty, that means whenever you buy a mobile phone, you get 1 year warranty. That is a compulsory type of warranty. In that case, no need to bifurcate the product and the warranty. Treat it like a single PO. Okay. But whenever you receive extended warranty, whenever you buy extended warranty, in that case for company, these are two. This is a separate PO. Mobile plus the compulsory warranty is 1 PO and the extended warranty is a separate PO. Okay. So if you want to have a look, I have made you write the example also in the notebook. One sec, I'll just show it to you. Here it is. So see, when you buy a mobile phone plus a compulsory warranty is a single PO. On this compulsory warranty, just don't forget to create a provision as per Ind AS 37. How to create the provision? They will give you the amount. Just make an entry warranty expense to warranty provision. Okay. Then if you sell an extended warranty also, then there are 2 POs. Then in that case, if there are 2 POs, you have to allocate the transaction price in the SSP ratio between these two. Whatever gets allocated to the mobile phone, book the revenue on day 1. Whatever gets allocated to the extended warranty, you will book over the period of 3 years. Simple. Okay. Now, so this was there. Now to understand this concept of warranty, we had few questions. We have 2 questions. One is illustration 35 and 36. 35 is more important. So what does it say? We sell a computer along with extended warranty. Okay, for 3 years. Then how much are we charging? We are charging a transaction price of 32,000 for both of them. SSP is given. SSP is 32 for computer and 4,000 for extended warranty. So we are not giving a discount. If you total up the SSP, it comes to 36,000. That is what you are charging. 2,000 is the expected repair defect cost. This is the warranty provision which you need to create. How to pass the entry? Simple. So first of all, you will say that you are receiving 36,000. There are 2 POs here. One for the computer and one for the extended warranty. Whatever you receive, bifurcate between these 2 POs in the ratio of SSP, bifurcation done. Whatever is allocated to computers, book on day 1. Whatever is allocated to extend a warranty, you will book across 3 years because the warranty is of 3 years. So how to pass the revenue? Cash bank to revenue, cash bank 36,000, to revenue 32,000, and to advance 4,000. This advance you will book across 3 years. Then in this question, cost of inventory was also given. So I pass the entry COGS to inventory also. So why to pass this entry? See, simple now. Whenever you sell any inventory, you pass two entries. You first book the revenue and you transfer the inventory to COGS. That is this entry. Okay, and then warranty expense to warranty provision 2000 was given. We passed an entry for that also. 36 is very similar. A simple question compared to 35. You can just give it a read. Okay, this was about warranties. Then next point is consignment arrangements. Now, what is the meaning of consignment arrangement? I took one simple example. Let's say I sell my FR books. Okay, so I don't sell to the student directly. I transfer my books to the bookstores. So there are offline bookstores where I transfer my book, and these bookstores sell it to students. So now the question is, for AK sir, when will the ultimate sale happen? When it delivers to bookstore, or when the bookstore sells it to customer? So the ultimate sale will happen only when the books are sold to the student. That is in case of consignment arrangement. So standard clarifies that in case of consignment arrangement, where you are the consignor and you transfer any goods to consignee, don't book the revenue when you transfer the goods to consignee. Revenue should be booked when the consignee sells goods to ultimate customer. Simple. Okay, chalo. Next is sale and repurchase. Again, a very interesting case. To understand this, we have some example in our notebook. Please have a look here. Sale and repurchase. So let's say, for instance, here is AK. AK is selling a product to Shri for 100 lakhs, and on day one also promises to buy back that same product from Shri after 1 year at 110 lakhs. So standard says, when you sell anything and you repurchase the same for a higher price, it is not a sale and repurchase. It is more like a financing arrangement where we are taking a loan of 100 lakhs on day one and we are repaying extra because of interest. So whenever you sell at 100 and repurchase at 110, it is more like a financing arrangement. Entries I have given here. Please have a look. Next, one more example. When you sell at a higher price, but to repurchase at a lower price, then in this case, it is not a financing arrangement. It is like a lease agreement. Why? Because on day one you sell, you receive extra money. And when you are repurchasing, you are giving less. Why are you giving less? Maybe you are charging this other party for the usage of the asset. Okay, so that is why it says, when you sell at a higher and repurchase at a lower price, it is more like a lease agreement. Maybe you are charging that other party for using the asset for 1 year. So I have given the entries also, you can just refer. So this was sale and repurchase. See, it is given also. If the repurchase price is more than original selling price, financing arrangement. If the repurchase price is less than original selling price, lease contract. Simple. Okay. Next point is bill and hold. Now, what is the meaning of bill and hold? Sometimes what happens is, a company sells any product to a customer. Please have a look. One sec. First we'll do the concept and then the remaining questions I will do. Okay. So what happens in bill and hold is, company sometimes sells something to customer. So Chroma is a company. It sells a MacBook to customer on day one. Sale on day one, payment on day one, billing also done on day one. But at the customer's request, the delivery is kept pending. Delivery is kept on hold. Okay. So when should Chroma book the revenue? So standard says, this might be a case of bill and hold where everything is done, asset is ready for transfer, but the customer is instructing not to deliver it ASAP. So what to do? So in that case, company should book the revenue on day one. Okay. Even if the physical delivery is pending. Okay. So but how to identify whether it is a bill and hold transaction? See, whenever it is a bill and hold transaction now, even if the delivery is pending, still the asset belongs to customer only. That means company cannot sell this asset to a third party. Okay, so it says, in a bill and hold arrangement, entity bills a customer but retains the physical possession at the customer's request. Some indicators are given to identify bill and hold. First, reason for bill and hold should be substantive. Reason may be at customer's request. Product must be identified separately as belonging to the customer. Even if the entity is keeping the delivery with themselves as of now, it should be specified that it is belonging to a certain customer. Product currently must be ready for physical transfer. An entity cannot have the ability to use the product or to direct it to another customer. Okay, so if the condition are met, it is a case of bill and hold. Standard also says one thing. When a company is holding the product for a certain number of period for the customer it might also charge the customer for some custodial services. So please try to identify whether there are any custodial service or not. For example, in case of bill and hold, that means if I sell a laptop and I'm holding at the customer's request, I might charge something for custodial services. So try to allocate a portion of TP to this service also. Why? Whatever is allocated to laptop, you will book on day one. Whatever is allocated to this services, you will book across the period. How many months service you are providing, across that months you should book the revenue of custodial services. Simple. That is the case of bill and hold. For bill and hold, we have one question also. If you want the referencing, I can give it to you. It is a very straightforward, simple question. And that is, I guess, illustration number 68. So basically here we are selling machine, we are selling spare parts. The delivery of spare parts is kept pending at the customer's request. So it is a case of bill and hold. So here there are not 2-3 POs. Why? Sale of machine 1 PO, sale of spare part 1 PO, and for bill and hold, the company might provide any custodial services. So third PO. So simple. Then they have given the indicators for bill and hold, which I just read with you. Simple. When to book the revenue? Machine sale done on day one, book the revenue on day one. Spare part sale done on day one, book the revenue on day one. Custodial services for 2 to 4 years. So book the revenue across 2 to 4 years. Simple. So this was bill and hold. I hope this is clear to everyone, right? Next point. Licenses of intellectual property. Now what is the meaning of this? Sometimes you sell your intellectual property like music rights, movie rights, team logo rights. So whenever you, just remember one thing, whenever you are selling your IPR, let's say you are selling it for 10 years. Don't look at for how many years you are selling. Just see whether you are selling any recorded content or you have an obligation to perform across 10 years. For example, let's say there is a SS Rajamouli production house. Okay, it is selling its old movies like Bahubali, RRR to Netflix for 10 years. Okay, so don't say that this production house should book the revenue across 10 years. No. Can I say they are selling their old recorded movies? Once the sale is done, this production house does not have to fulfill any obligation. So this production house should book the revenue on day one. Okay, it is just like AK sir selling the recorded lectures, FR recorded lectures. So I will book the revenue on day one. On the other hand, if I take a live batch where I will have to come and teach every day for 3 months, then I will book the revenue of over 3 months. Similarly, if this production house contracted with Netflix that for upcoming 5 years, this production house has to make 5 new movies and 3 new web series. In that case, they will book the revenue over the period. Why? Because when you are selling a upcoming intellectual property, you have an obligation to complete. That is why. Simple, right? So just remember this part, and to just understand this better, we have few questions I have mentioned also. You can refer illustration 69, 71, 72. I will just go to this once. In illustration number 69, we are selling some old recorded symphony songs. So it is like selling old movies. Book the revenue at a point in time, one shot. 71, we are selling a completed film like a recorded lectures. Book the revenue single at a point in time. 72 is interesting. Here we are selling a team logo. So let's say you are the team, you are giving the rights of a team logo to Nike, a sports brand. So how should you book the revenue? So when you are a team which is playing currently, let's say you are an IPL team, you are not banned, you are playing currently. So when you sell your logo for a certain number of years, you will book the revenue over the period. Why? Because you have an obligation to maintain your name for that certain number of years. Let's say I sell the Nike 3 years, right, to use my team name and logo. So this team has an obligation to maintain its name in the market because so that Nike can use it. So yes, CSK will book the revenue over the period. But what if a defunct team is selling its team name and logo? Let's say Deccan Chargers is the Hyderabad team which is selling its name. It is a defunct team. It is not playing anymore. So if this team is selling its logo to a brand, then here this defunct team, it is already closed team, right? They don't have to fulfill any obligation. They don't have to maintain any name. So here they can book the revenue at a point in time. Okay, so this was a very good question. You can have a look here. So this was license of intellectual property. Simple, done. Next point is contract cost. Okay. See, in full Ind AS, we always talk about revenue. This is the only point where we will talk about cost. Okay. When it is relevant only when the contract duration is more than 1 year. Why? When the duration is more than 1 year, can I say we book the revenue across those period? Let's say contract duration is 3 years. So we book the revenue across 3 years. So similarly, even the cost should be booked across 3 years. No? That is the main fundamental around this point. So it is more relevant when the contract duration is more than 1 year. Now how to account for this? So it simply says that in contract acquisition, there are 2 types of cost. One contract acquisition cost. One is contract fulfillment cost. What is the meaning of contract acquisition cost? Any cost which you pay to acquire the contract. Now in this also there are two types of cost. One is sunk cost. You incur the cost, you might get the contract, you might not get the contract. Okay, so sunk cost, transfer to P&L simply. If it is a direct cost, that means any cost which you incur to acquire the contract and it is directly attributable. That means you incurred this cost only because of this contract. In that case, you will capitalize the cost and book across the period of contract. Second is contract fulfillment cost, the cost which you incur while fulfilling the contract. So here also two types of cost are there. One, that cost is covered under any other Ind AS, like it is covered under Ind AS 2, Ind AS 16, Ind AS 38. So if it is covered under any other Ind AS, account for those costs as per the respective Ind AS. But if it is not covered under any other Ind AS, you will again capitalize the same as per Ind AS 115 and book across the period of contract. Simple. Okay, some conditions are given, of course. The cost need to fulfill these conditions. Now to understand this better, we have one simple illustration. I will show it to you. Illustration number 73. What does it say? Let's say there is a contract which is having a tenure of 5 years plus 2 1-year renewal terms. So basically average contract relationship is 7 years. We spend 4 lakhs. Now how the 4 lakhs are spent? See, design services. Are design services covered under Ind AS? No. Cover under 115 and amortize over 7 years. Okay. Then we incur cost of hardware. Hardware is covered under Ind AS 16. So account as per Ind AS 16. Software covered under Ind AS 38. Account as per Ind AS 38. Migration and testing of data center not covered anywhere. So account as per 115 and amortize across 7 years. Simple. So if that cost is covered under any other Ind AS, cover under that respective Ind AS. If it is not covered under any other Ind AS, cover it under Ind AS 115 and amortize across the period of contract. Simple. So it is so simple. Yes, it is simple. This is contract cost. One more thing is there in contract cost which I would love you to read, that is examples of contract acquisition cost. So this was a November 23 question which came for 5 marks. So just give it a read. These are examples by ACI. Whether this acquisition cost will be sunk cost or will it be capitalized and booked across the period of contract. That is what you have to study here. Okay. Then the next concept here is service concession arrangement. Now what is the meaning what is there in this point? Please have a look here. So I have made you write everything in the notebook. Please have a look. A service concession arrangement is basically where a government hires a concession company to build public utilities like tolls, bridges, national highways, etc. Okay. So here in service concession arrangement, there are two parties. Government, also known as the grantor, and the concession company, also known as the contractor. Now from whose point of view are we doing the accounting? We always do the accounting from the company who is going to earn the revenue. Here construction company will earn the revenue, so we will do the accounting for this construction company. So now here there are two cases. First case, where this company will construct the bridge, maintain the bridge, okay, and government will pay money to the construction company. So here for construction, let's say this company is charging 80 CR. For maintenance, it is charging 20 CR. And because the government will give the payment at a later year, so it is also recovering the interest. So basically 115 is the total revenue which company is going to earn. So how should the company book the revenue? So here year-wise entry are not expected. You need to pass the gross entries, but you should be able to justify it. For example, this amount which we are charging for construction, we will book over the period of construction. So we will say receivable to revenue. Why receivable? Because money is not received as of now during the construction phase. Also, if you incur any cost during construction phase, book that cost also, expense to cash bank. Next, whatever you charge for maintaining the toll, you should book in the operation phase. So in the operation phase, book receivable to revenue. This is the maintenance revenue which you are going to earn. Interest for late payment. So this will be booked across the tenure. So interest, receivable to interest income. And then at the end, you will receive the money cash bank to receivable. Simple. So here you are receiving money for three things: construction, maintenance, and because you are receiving the money late, interest also. Now there is case 2 also here, where government is saying that it will not pay anything to you, but it will give the license to operate toll, and whatever money you collect from toll, it will belong to you. So government is telling the construction company that they will not pay anything, but they can run the toll and collect the money from the customers or from the public. Okay, so here in the construction phase, the construction company cannot book a receivable because they are not going to receive the money, but they are going to receive a license. So they will book an intangible asset to revenue. Let's assume that the license worth is 150 CR. So book 150 CR to 150 CR. And If you incur any construction expense, book expense to cash bank. Then during operation phase, two things to be done. You will receive the money from toll. Whatever you receive, it is your revenue. So book cash bank to revenue. Whatever you receive, assuming that you receive 250 CR, book 250 CR. Then because you booked an intangible, let's say the license tenure was for 10 years. Government give the license for 10 years. So you need to amortize the license also. Amortization to intangible asset 150, 150, simple. Okay. Acha, don't get confused by one thing that you might say that, sir, revenue is getting booked twice. You are booking the revenue for intangible also. You are booking the revenue for toll collection also. It is not getting booked twice. Why? This intangible for which you book a revenue, can I say it is amortized also through P&L expense side? So ultimately your core revenue is only toll collection money. Okay. Anyways. So based on this, we have a illustration also, illustration number 75. Exactly the same thing which I just mentioned. There are two toll projects. First, where the government will pay you money. Okay. And the second, where the government will give you an intangible asset. Okay. So if you want, I'll just give an overview of it. Please have a look here. First of all, there are three parts to this question. First part, they are telling you to give a brief reasoning how to account for this first project. So you will say you will book a receivable and everything. In the second, give a brief reasoning. So you will say you will book an intangible here. And third, give the entries. So entries part is more crucial, of course, but theory also carries marks. So don't forget to write the theory. Then for the first project, you will say you are going to receive money. So receivable to revenue. Then whatever expense you are going to incur across 3 years, book that. So in question, to confuse you, they have given two expense. One, what you incurred in first year, and the second, what you are going to incur across the construction period. So because we are passing the entry for the whole tenure, pass the entry for the whole construction period, not only for the first year expense. Okay, do remember that. What you will receive for maintenance, book in the operation phase, book the interest income, and book the money received. In the second expressway, you are going to receive an intangible. So book an intangible, book the expense, amortize the intangible, and whatever money you collect from toll, you book bank to revenue. Here, standard, the question says toll collection money was missing. So that is why we use question mark here. So I just gave an overview of this question. Of course, do self practice of it as well. Okay, chalo. So this was your service concession arrangement point as well. Okay, done with this. Now, is the chapter over? Of course not. There are some questions which I need to cover in the revision as well. I will cover those questions. So let's start one by one. The first question out of it is illustration number 22. So I'll go in line wise. Whatever is pending, I will just keep on taking it up. Okay. See, I'm not revising all the questions, but I'm going to focus more on the questions which are crucial or which are tricky. Okay. First of which is this membership question. So it says that entity sells gym membership for 7,500 per year to 100 customers. Okay. And if they renew in the subsequent years, you will charge only 6,000 per year. Attrition rate is 50%. That means 50% consumers won't renew. Okay. Revenue in first year. We need to check how much is the revenue in first year and the liability in the first year. So why to do this? You are going to receive 7,500 in the first year. But because of this, you are also given discount in subsequent years. So you need to find a revenue per customer per year. So I find the number of customers. I find the fees, total them up. You can take the total of this, divide by total number of customers. You will get a revenue per customer per year. So let's say, for example, in the first year, receiving 7,500. The revenue is only this much. Balance is the contract liability. Simple. This was illustration number 22. 23 already revised. 24, nothing is great in this. Next good question is illustration number 38, 39. Okay. 35 already done. 38 is simple, but 38 shall I revise it? In 38, basically, company is selling a product on first day. Okay. But the customer makes a payment after 24 months. So customer is paying extra. So here there is significant financing component. So how much is the revenue? Revenue is going to be 1 lakhs only. And financing component, whatever you are paying above that, 21,000 is a financing component. So I have tried to pass entries here. Okay, receivable to revenue, then receivable to interest, and whatever you receive, reverse the receivable and book a cash bank. Simple. So basic fundamental was your revenue is 1 lakh and your interest 21,000. Next question, important question now. What does it say? So basically, again, you are selling a equipment. Okay. But the customer is going to pay after 60 months. So you are charging a 10% interest. Okay. Customer is paying in 60 monthly installment, not after 60 months, in 60 monthly installments. So you are charging extra. So they have asked two things. What is the discounting rate and what is the TP? TP is going to be 1 CR. Why? If the customer paid on day one only. It would have paid only 1 CR. So yeah, this is the transaction price, 1 CR. Okay. What is discounting rate? 10%. Simple. Now there are two cases. Case 1, contractual rate reflects the rate in a separate financing transaction. In case you remember, we discussed this in class. If the rate, contractual rate means the rate you offer to the customer in the contract, and separate financing rate means the rate which is ongoing in the market. So if your contract rate is equal to your market rate, then your delivery day price will be equal to your transaction price. But in case B, it says that your contract rate, that is 10%, does not reflect a separate financing transaction rate. That means the rate you offered in contract is not same as the market rate. Okay, so what to do in this case? So your contract rate is not equal to your market rate. Then the delivery price won't be equal to transaction price. In this case, you will have to find the amount of revenue by doing present value of future cash flow at EIR. This has some linking with financial instruments, right? Whenever the rate are not same, you need to find the present value, right, to book the amount of revenue. So your revenue won't be 1 CR. Okay, so the revenue will be present value of future cash flow at EIR. Here monthly payments are there, so EIR should also compute be monthly. So I taught you how to calculate this. Okay, 212,470 60 monthly installments into annuity factor of this rate. So I have given the calculation, you can see. So this comes to this much present value. This is the amount of your revenue. Whatever excess you receive, it is your interest income. Simple. So the B part of it was very important. We have one more question, illustration number 40. Here the control will be transferred after 2 years. So revenue should be booked after 2 years, but customer is opting to pay in advance 4,000. If the customer paid on the date of delivery, it would have paid 5,000, but here customer is paying in advance, so it is paying less. 4,000 it is paying. Now here also there is a problem. Problem is contract rate is 11.8%, but the market rate is 6%. So how to solve this? See, it is different from the previous question. In previous question, control was getting transferred first day and the payment was happening subsequently. Here the control is getting transferred subsequently, but payment is in advance. How to do this? So first of all, when two rates are given, always consider the market rate only. Ignore the separate, ignore your contract rate. Okay. So whatever you receive 4,000, book as an advance. On that advance, accrue the interest. Okay. Interest expense for 2 years. Add 6%. Then total advance balance will go to 494. Transfer that to revenue. Sir, but the revenue amount should be 5,000. No? It would have been 5,000 if the contract rate and market rate were same. In this case, because they were different, the revenue won't equate to 5,000. It will stop at 4,494. Simple. Remember, I have given the reason also here. Okay. So this was illustration number 40, a very good question. Now in sequence, which other question comes? I will discuss only good questions. Okay. This 56 is a very good question. Please have a look here. I will urge you to, if you don't understand this, please have a look at the solution also, which I am giving in the board notes. Please have a look. So it says we have two licenses, license A and B. Okay. The SSP is given. License A SSP is 16, license B SSP is 20. The entity transfers B at inception and A 1 month later. Okay. Then case A is given. License A, we will receive a fixed amount. And for license B, it is based on a 3% variable consideration. 3% of sales you will receive. Expected variable consideration is 20 lakhs. So how to account for this? Allocate the TP. So basically, see, your SSP was also 16 and 20. And your allocation is also given as 16, 20. So no worries with it. How to solve this now? Please have a look here. I have prepared a good summary of this. So you can say, see, in license A, first I wrote the SSP of both the licenses. Then when it is getting transferred. So license A is getting transferred after 1 month. So we will book the revenue after 1 month. License B getting transferred on day 1. So book the revenue on day 1 normally. But for license A, consideration is fixed. 16 lakhs. When to book the revenue? Book after 1 month. Simple. For license B, consideration is variable. It is based on sales. So even if the license is transferred on day 1, you can't book the revenue on day 1. Why? Because it has not accrued as of now. It is based on sales. When the sales will happen, revenue accrues. Royalty accrues to you, right? So even if the license is transferred on day 1, still you will not book the revenue on day 1. You will book the revenue as and when sales based royalty is received. Simple. This was case A, a pretty straightforward case. Interesting is case B. It says in case B, license A, we are charging a fixed amount of 6 lakhs, and license B, we will charge 5% of sales. Estimated is 30 lakhs. Okay. License A is transferred 3 months later. Royalty of first month is 4 lakhs. In the second case, the standard says your allocation given by the contract is not reflecting the SSP. If you see SSP is 16 and 20, but the contract says 6 lakhs for A and 30 for B. So it is clearly showing that this allocation given in the contract is not depicting the SSP ratio. So what to do? In this case, standard says you cannot say that 6 lakhs is for license A and 30 is for license B. Standard says whatever money you receive, it will be bifurcated in both the licenses in the ratio of SSP. For example, 6 lakhs was for license A now. Don't say it was for license A. Say that this 6 lakhs bifurcate between A and B in the ratio of SSP. So when you bifurcate, for A you get 2.67, for B you get 3.33. A is transferred in the case B after 3 months, so book after 3 months. B is transferred inception. This is fixed revenue, you can book on day 1. Okay. Same with the variable consideration. Now out of 30 lakhs estimated, in first month we receive 4 lakhs. So I will talk about the 4 lakhs only now, because estimated 30 lakhs, but how much did we receive? 4 lakhs. So this 4 lakhs also transfer between both the licenses. Okay, this is the difference between case A and case B. In case B, whatever you receive, account for it, allocate it in both the licenses. In case A, because it was depicting the SSP, no need to allocate between both the licenses. Simple. So 4 lakhs you receive, bifurcate between A and B. For A, because the transfer will happen after 3 months, you can book the revenue after 3 months only. For B, transfer of license has already happened. So first month sales royalty you can book after first month. Simple. Clear? Yes. So good question. I would suggest please give it a self-read also. See, I have tried to revise it, but of course there is no replacement of self-revision in this case. Okay, chalo. One more concept, illustration number 65 you can see. Now before that we will see the concept of unused material. So what happens is, sometimes let's say you have a revenue of 50, you have a cost of 40 lakhs. Contract of 3 years. Sometimes you incur a cost which does not depict the stage of completion. For example, you purchase an elevator, but you don't install it. So you should not say that this much work is completed. So in that case, whenever you incur any cost which does not depict the percentage completion, you should book the revenue only up to cost. You should book the revenue only up to cost. So for example, total cost incurred, let's say, is 40 lakhs. Out of which 10 lakhs you incurred on elevators now. So this 10 lakhs you can book the revenue only up to cost. For the balance cost, 30 lakhs, you incurred 5 lakhs out of it. Find the percentage completion for this balance cost. Okay, that is 5 divided by 30 into 100. Similarly for revenue, out of 50, 10 lakhs you will book straightforward for elevators. Okay, because for elevator we will book the revenue up to cost. For the balance revenue, 40 lakhs, apply this percentage completion. Okay, so total revenue will book is 10 plus the 6.67, 16.67. So if I want to summarize this for you, do remember that whatever cost to incur and whatever revenue you book, separate the elevator part out of it. Okay, so this much cost to incur for elevators, because it is not installed, book the revenue only up to this much. For other cost, find the percentage completion and that percentage apply on the balance revenue, not on total revenue. Okay, balance revenue into percentage completion, you can book this much revenue. Based on this, we have one question also which you only solved in class, in case you remember, right? TP is revenue 50 lakhs, cost 40 lakhs, for elevator is 15. Out of this remaining 25 you incurred 5 lakhs. How to book this? Simple. Out of 40, bifurcate into elevators and other cost. Elevators separate, other cost balance 25, out of which 5 we incurred. So percentage 20%. In revenue also, out of 15, first book up to elevators 15 lakhs. On balance 35 apply 20%, 7 lakhs. So total revenue will book is 22 lakhs. Is this clear to everyone? Yes. 65 is done. Similar to this is 78 also, where instead of elevators we have ACs, air conditioners. So simple. You can refer that also. Apart from that, bill and hold is already done. 72 already done. 73 done. 75 done. 77 is a barter question. So you can just give it a read. I have given the solution also here. You can just give it a read. Okay. 78 is same like 65. 79 is an interesting question. See, I'll just give a briefing of it. Not LDR, but a basic question. See, basically we sell a machine on EMI basis. Okay, we sell a machine where we receive a down payment of 1 lakh and balance we are giving a EMI option to the customer. So here it says when to book the revenue and also mentions that customer obtains control at the inception. So normally we will say that we should book the revenue on day 1 as a company, even if consideration not yet received on day 1. Sale has happened, so you can book the revenue on day one. But in this question, there is a presumption that it is not probable that customer will make the payment. It is presumed, while if you see the solution, you will find this. It is presumed that it is not probable that you will receive the consideration. Okay, so when they have answered it, they have said that because it is not probable that you will receive the consideration, we cannot book the revenue until it is certain that you will receive the whole consideration. So whatever money you keep on receiving, book like a liability until it is able to conclude that it is probable that entity will collect the consideration. Just give it a read, you will understand now. Clear with this? Chalo. Then we have a chunk of questions 80, 81, 82, 83, 84. Let's see. 80. It says we sell something for 2 lakhs, but we expect to collect only 1.75 lakhs. What would be the amount of revenue? 2 or 1.75? Revenue is always what you expect to receive, so it will be 1.75 first. Second, you sell, you enter into a contract with the customer. These are the price per containers. So if the customer buys between any particular sales volume, this is the respective price. So customer is going to buy 2.8 million. So basically that TP should be 90 rupees. But as of now, customer has bought only 7 lakhs. It is expected that during the whole year he will fall in 2.8 million. But as of now, he has purchased 7 lakhs and we have charged him 100 rupees per container. So what to do? So if you expect that you will be able to make this much sale, even if you receive 100 rupees, you will book the revenue only up to rupees 90, and balance you will book like a contract liability, that is rupees 10. That is exactly what we have done. 100 rupees revenue, 100 rupees cash received, 90 rupees revenue, balance 10 is contract liability. Simple. Okay. Then 82. 82 we sell a razor, 50 rupees. And against that we give a rebate coupon. ICI treats it like a cashback. Assume that we gave a cashback of 2.5. So book the revenue at 47.5. But there is an alternative solution also possible here. Actually, this is a coupon. This is like a voucher. So for voucher, you don't do like this, that directly reduce 2.5. We bifurcate in the ratio of SSP. The value of razor was 50. The value of voucher is 2.5. So if you allocate, then for razor you get this much, 47.62, and for voucher you get this much. Okay, so you can do this also, but I feel ICI has done like this. You should do an exam like this only. You will understand this only when you read the question, huh? Only when you know the concept. 83. It is about price protection. You sell something for 1000 rupees. You offer a 5% price protection. In case you remember the concept, in case of price protection, we book the revenue on net basis. So 1000 minus 5%, 950 will be your net revenue. That's it. Okay. This completes all the questions of module along with the relevant concepts of Ind AS 115. Of course, there are questions of MTP, RTP also, but we have tried to cover all the concepts along with all the questions of module as well. Okay, there are MTP, RTP questions also, which is there for you. Okay, so but till module and till all the concepts are done. Okay, so I hope this revision was helpful for you. Okay, please also remember one thing, even if you revise with me, self revision is also important and self practice of questions is also important. So don't forget that as well. Okay, so on that note, we'll wrap up this revision also. Thank you so much. Bye bye everyone. Take care. See you all. Chalo guys, so we will also quickly revise all the important questions of MTP, RTP and past paper also. Okay, so solution is also available, question also available. So we will try to revise it. Of course, do remember these are some quality questions which I will revise. So writing practice is a must. There is no replacement of writing practice. Please do remember that part. Okay, still I will just go through them so that you have an idea of what is happening in the question. So the first question is related to loyalty points. It says whenever customer makes a purchase of 500 rupees, they are granted 10 points. The value of 1 point is 0.5. Okay, chalo. So now and which are valid for 2 years. During the year, the company made an issue of 1 crore points. That means imagine the sales which they have made. Okay, for issuing 1 crore points, out of which 18 lakhs point remain undiscounted. Now what to do with this? I will revise. First part is assume that 10 lakh sale was happening. Okay, so this first part is not linked to this 1 crore points. So this is a mutually exclusive part. So if a sale of 1 lakh is happening, 10 lakhs is happening, first of all try to compute how much points you must have given. So for a 10 lakh sale, how many points do you give? So just check. For 500 sale, you give 10 points. So for 10 lakh sale, you give 20,000 points. The value of each point is rupees 5. So basically you are giving 10,000 voucher value. So in terms of value, it is 10,000 and in terms of points, it is 20,000. So for a 10 lakh sale, you give 10,000 worth points. Okay. Now the transaction price is 10 lakhs. Bifurcate them. okay, in between the SSP, in the ratio of SSP, you will get the allocation. Now why to allocate? Because whatever you get for the sale, you can book today, but whatever you get against the points, you will not book today. You will either book when the customer redeems the points, or you will book after 2 years when the points are lapsing. Okay, so this was the first part of it, not linked to the 1 CR points. Now the second part is linked to 1 CR point. What does it say? In the second point, they are saying, assume that we have made a sale of 5,000 lakhs. When you make a sale of 5,000 lakhs, now you issue 1 CR points. That is why I'm saying the second part is linked to the information given. So we will clearly do the same thing, but for 5,000 lakh sale. What we did in the first part was for 10 lakh sale. Now we will do the same thing, but for 5,000 lakh sale. Okay, so if you make a sale of 500, you give 10 points. If you made a sale of 5,000 lakhs, you give 100 lakhs, that is 1 crore points. The value is 50 lakhs if you multiply by 0.5 rupees. Just give the allocation. Now whatever is allocated to sale of goods, you can book today. Whatever is allocated to voucher, you will not book today. Okay, you will book in future. Now if I ask you, how many points did you give for this liability? You gave 1 CR points. Okay, but not 1 CR won't be the correct answer. I'll tell you why. They are mentioning that out of 1 CR points, 18 lakhs remain undiscounted, and management expects that only 80% will be discounted in future. What is the meaning of this? So in case you remember, we discussed also that out of 1 CR points, if 18 lakhs remain undiscounted, that means 82 lakh points are redeemed. Second, out of the pending 18 lakhs, only 80% will be redeemed. So in short, how much total points are redeemed as per company's expectation? 82 plus 80% of 18, that is 14.4 lakhs. So in general, customer redeems only this much points. So this liability, we will assume it is not for 1 CR points. We will assume that it is for only 96.4 lakh points. Simple. Okay. Now out of 96.4, 82 were redeemed. So book the proportionate revenue. Book the proportionate revenue. Okay. What is the balance of advance? We found out. This is the balance of advance. How come balance of advance? This is the advance you booked. This is the advance you reversed, because 82 points were redeemed. Okay, so this is the balance advance. Okay, now it says in the next year, out of 18 lakhs, 60% were redeemed. So 10.8 lakhs points more were redeemed. So again, you will book some proportionate advance and transfer it to revenue. Okay, the advance relates to 14.4 lakh points, and we redeemed 10.8 lakh points. So this much revenue will book. Again, if you are finding it difficult to understand, try to practice it on your own and refer the solution again. Okay, then what will happen with the balance advance? It will turn the closing balance. Now the 2 years are over. Okay, after 2 years, irrespective of how many points the customer redeems, the full advance balance will be transferred to revenue. That is why what we do in the last part, they are trying to confuse us. They are saying that 3 lakhs points were redeemed. Doesn't matter. Even if the company or the customer redeems or not, irrespective of points redeemed or not, company will book the full revenue, because that is the last year. Either the points will be redeemed or they will lapse. Company can book the revenue. Okay, so there are 5 parts to it. First part for the 10 lakh sale. Second part for the 5,000 lakh sale. The important point here is the allocation of voucher is not for 1 CR points. It is for 96.4 lakh points. If you are able to get this, remaining part is very simple. Okay, please remember that part. Chalo. Then we move towards further question. Let's see if you have any quality more questions. Question number 2 is simple. You can just give it a read. Question number 3 is a good question. It is basically based on construction contract. So what is given? We have 2 contracts with A and B. It says total sales value, total cost, and percentage completion. So what to do with this? Whatever is the total cost, you will apply the percentage completion. Whatever is the total revenue, apply the percentage completion. That much revenue you can book. So for example, your total sales was 40. Completion was 30%. So this much revenue you can book. Now if you read the question carefully, they are saying that we received some payments of 13 lakhs. How much payment you receive doesn't matter, because we are following accrual basis. So even if you receive 13 lakhs payment, accrued is only 12 lakhs. So 1 lakh is advance you will show. Same for B company, also data is given. Then for cost also same thing. Total cost expected was 34 lakhs. Completed was 30%. Total accrued is 10.2 lakhs. Okay. Now we paid 16 lakhs. Doesn't matter. How much cost is accrued? 10.2. So whatever excess you paid, it is like a contract asset for us. Same data is given for contract B also. So they want us to give the extract. So what will be the extract? 2 items will come in P&L. One is the revenue accrued and one is the cost accrued. And 2 items will come in balance sheet. One is the excess money which you received like an advance, and one is the excess cost which you paid in advance like a prepaid expense. We call it contract assets. This much. That's it. This was question number 3. A very simple and a very good question. Okay, let's proceed further. Now we have question number 4. Again, a very good question. Please have a look here. So they have given multiple sales volume. Of course, it implies that if you achieve sales within this much volume, price is this much, and if you achieve higher sales, the price is this much. Okay. Now in the first part, they have given a probability weighted sales value, that you will be able to sell 9,000 units, probability is 15%. You will sell 28, probability is 75%. You will sell 36,000, probability is 10%. What to do? You have to find the probability weighted average price. So basically find the probability weighted sales and find the probability weighted sales value, that is sales units multiplied by the price per unit. You will get the sales value. Okay. So when you divide by the sales value divided by number of units, you will get average selling price. You get to 79.13. So basically now how will you account for this? Just remember, how much money you receive doesn't matter. Revenue should be booked as per 79.13. Okay. So for the first 10,000 units, when you sell the first 10,000 units, money you will receive extra, but still you will book the revenue this much, balance is advance. For the next lot of units, you will receive money less only. Why? Because you promise that once the volume increases, you will receive less money. So you receive less money. Also, because in the first lot you received some extra money, you will have to refund that 10 rupees extra also. So this is the cash received. Doesn't matter, revenue booked will be 79.13. Excess will be adjusted through advance. So now here advance won't be created, it will be reversed. Okay. And once the contract term is over, if there is any balance in advance still left, you will transfer it to revenue. This is the first part. In the second part, they tell us to use the most likely method. Most likely method, we don't multiply our probability. We just take the higher probability sales value. Remember, in this method, we don't multiply by the probability. Yeah? So don't make the mistake of multiplying by probability. So we assume that 28,000 will be our sales because that has the highest probability. And if you see that sales volume, it will be rupees 80. Okay. So here also for the first 10,000 units, we will charge as per 90. Balance you will book like advance. And for the next 18,000, you will charge only as per 80 and refund also the excess on the first lot. Okay. And book the revenue. Balance you will adjust from advance. Okay. So this. And third part, they were asking the entries. Entries are already discussed for both the parts. So again, a very good question. Please practice that question as well. Okay. Let's proceed further. Now, what do we have? One sec. Yeah. Question number 5, can just give it a read. It is a very simple question. Question number 6 also you can just give it a read. Solution of question number 6 is there in the board notes. If you want to refer, you can refer it. Okay. 7 is a very good question. Please have a look here. What does it say? So I'll just try to summarize it. It says we are selling a machine model Pi on 1st April 18. Along with that, we are giving two services, maintenance service on 30th September and 1st April 19. Okay. Payment we are receiving on 1st April 19. So if you see machine sold on 18, payment receiving 19. So that means we will also charge for some finance component. So that is exactly what we did here. Please have a look here. See, question number 7. So we are selling that we are giving this machine and these two services. So because the payment is received after 1 year, we will charge for some finance component also. So the SSP of machine and services are given in the question if you read it carefully. The balancing figure I will treat like a finance component. Now how to account for this? So they want us to separate the 4 lakhs between all the 3 parts. So first part is how many components we have. We have 3 components: machine, services and finance component. Next is they want us to bifurcate the 4 lakhs between all the 3 services. We already did it, but they don't want us to do it like this. They want us to prepare a table. This table is similar to LAT, loan amortization table, where we write opening, interest, repayment, closing. The only difference is here opening will come, finance income will come, and the other 2 components will also come. Then repayment, receipt, then closing. I will help you with this. For example, on the first date, there was no opening. But on the first date, did any of the 3 components accrue any revenue? Yes. Sale of machine accrued a revenue. So book that. Repayment received nothing because payment will be received after 1 year. Closing date. After 6 months, book the finance interest. Rate of 5% for 6 months was given in the question. So we booked the finance income. On this date, did any other revenue accrue? Yes. A revenue for service will accrue. Booked it. Closing you get. Then on the year end, book the finance income again. Then on the year end, no payment is received, neither any service accrued. Because on the, what about the second service? The payment for second service accrues on the next day of the first day of the next year. Right. So it accrues on the first day of the next year and we also receive the payment. This is something which you will understand once you read the question carefully. I'm just focusing on revision here. Okay. So this is how you segregate as per the solution given by them. Okay. And how do you get the SSP? What is the value of services? They have given the cost of services given, and they have given like we keep a margin of 50%. So you will get the SSP of services. Simple. In the third part, they are telling us to pass the entries. Entries is very simple. Just look at the table and keep on passing the entries. Whatever date you have any amount besides it, just pass the entry for that. Okay. And the fourth part is showing like extract. Extract means showing how much revenue you will book in all the 3 cases. So we already have that extract. In revenue, you will show all these 3 separately: sale of goods, services and finance income. Simple. Then we also have a question number 9, which is a good question. What does it say? It says our revenue was 20, our cost was 11 as of now. There was a bonus also, but it was expected that we will not receive it, so we did not book it. Our percentage completion was 65%. So what to do? Simple. If your total revenue is 20, percentage completion is 65%, book 65% revenue. That is what we do. So we book 65% revenue, and similarly we will also accrue 65% cost. Now what happens subsequently is our revenue and cost both are expected to increase, and also now the bonus is expected to be received. So what will happen? So once the cost is expected to increase, the percentage completion changes. Why? Because assume that the cost incurred is same, but the divisor, that is the denominator, will increase now because the total cost is expected to increase. So your revised percentage completion is 60.59% now, right? So that means now the revenue that should be booked, it should be on, you can say, the revised amount, that is 24 lakhs. Acha, please rectify this. I have written 20 lakhs, it should be 24 lakhs. Really very sorry for the silly mistake. So revenue booked should now be on the revised revenue as per the revised percentage completion. So this is the revenue that you will book, 24 into 60.59%, out of which 13 you have already booked, so balance you will book excess. So that means in this question, what is the important part? Once the expected cost increases, your percentage completion changes. Okay, do remember, percentage cost increases, that doesn't mean that you have incurred the cost, it means the total cost expected to rise. Okay, do remember that. So this is one question which we did, question number 9. Apart from it, the remaining 3 questions, question 10, 11, 12 are basic questions. You can just practice them on your own. Okay, so this is the revision of Ind AS 115. So of course in MTP RTP questions you will find you must have find 3-4 questions which are good questions. Okay, so please focus on the writing practice of them also. And 115 as a whole is a very good Ind AS. It comes in exam for sure. As of now, it has come in every attempt. Okay, it has a good weightage. So please don't leave that Ind AS. Do it very properly, revise it very nicely. Okay, so on that note, we will end this session. I hope this revision was helpful. If you are watching this on YouTube, please do like the session. And for notes, you can join my Telegram channel. I will upload it on that. And best of luck for the studies. If this was helpful for you, please recommend it to your friends as well. Okay, on that note, thank you so much. Bye bye everyone. Take care. See you all. Bye bye.